sorry to tell you this, but there is no Fed pivot. And once people realize this, the cracks in the stock market and the real estate market will be more apparent than ever. Today we're talking about real estate. Today we're talking about how the tables will turn. And this will become an opportunity for many of you to become landlords in the future. Now, I have made this video designed for beginners. And today we're going to talk about why the US real estate market is so stubbornly strong, but mark my words, why falling prices will come. And we're going to talk about what drives real estate's resilience and what could break it. And we're going to do that by studying the consumer, the health of the consumer, their spending patterns. And then finally, I'll share some perspectives on how to get ready for what could be a very scary moment in the next 18 months. So before I get into the next slide, I want everybody to understand that this is a long-term diagnosis. This is not what I believe will happen in the next month or two. The next month or two could be fine, but the next 18 months, I don't think will be so fine. Now, connect with me on social. Periodically, I share premium exclusive work to all my friends on my email list, a link in the description below. And I also discuss short form thinking on my Twitter, and I talk about visual commentary on my Instagram. So be my friend there as well. We can see here that my public emails give all my readers deeper perspectives to develop critical thinking in a world filled with noise. And now, with that said, let's jump into the video. If you're new to my channel, my name's Larry. I talk US and China macro. Today we're talking about real estate. Let me give you a summary of what's happening in this market. Home prices cooled at a record pace in June, according to a very important data source called Black Knight. And the real estate market, my friends, is going to accelerate its downturn. The signs are very clear. US new home sales, they've fallen to more than a 2-year low. And I want to tell you what the Fed actually said at the July FOMC. It's not about what the media summarized, what Jay Powell said. It's about what he actually said. So let me tell you what he actually said. He said that we're getting close to the neutral rate. And the market is getting very optimistic about this because they believe that the Fed cannot raise rates much further than they are now because they would be restrictive. They also focus on how the pace of hikes could be slowed in the future. But what the market is not paying attention to is that the Fed could do an unusually large hike in September based on inflation data that will come out shortly. And more importantly, the Fed discussed that they will make growth below trend. Now, I have no idea why the media outlets are not reiterating this, but when growth is below trend, that is another way of saying that they're going to cool down the economy significantly from here to fight inflation, to keep price stability happening. So the Fed is going to target the unemployment rate to soften demand to lower inflation. And this is going to be very painful. I can't stress this. I can't stress this enough. Now, I know the S&P 500 and the NASDAQ are showing signs of strength. And I personally believe that this month, August, should be relatively stable and okay for the US stock market. But going into this fall, that's when significant volatility will return. And I want all of you to mentally and psychologically brace for what could be a very challenging rest of the year when the summer ends. Now, the only reason that housing prices haven't crashed yet is that inventory is tight. Now, this is my opinion, but I believe that this is one of the only reasons the housing prices haven't corrected significantly, is that there's not a lot of homes out available on the marketplace. But that is going to change very soon because of the current macro landscape that we're in. We can see here from Black Knight, the largest monthly inventory gain has happened in 12 years in this past month. And according to their estimates, it could take 5 months or more for the full impact of recent interest rate spikes to be reflected in traditional home price indexes, which suggest the potential for even stronger slowing to come. Now let's examine the market cycle that the real estate market is likely in. As we can see here, just like every sector, there are booms and busts with the cycle. And in my opinion, all the new construction, all the new supply that has hit the market has yet to be reflected in people's ability to pay for those prices. Let me give you some examples. In neighborhoods near the Boston metro area, there are 1-bedroom apartments in neighborhoods which I'll just describe as less than favorable that have 1-bedroom prices at anywhere between $2,800 and $3,200. Now, in my opinion, and this is my personal perspective, these prices make absolutely no sense relative to the income that people earn in my state in Massachusetts in the US. And Massachusetts is a relatively wealthy and affluent state compared to other states in the US. And so if I believe that rent is a problem in Massachusetts, I can't even begin to imagine what rent feels like in the rest of the US where disposable income is less. And I do not believe that the US has avoided recession. The media will make you think that way, but mark my words, we are in a recession. So what happens during a housing correction? Well, there will be far lower and weaker transaction volume. Home prices could fall quickly, and that means purchasers may find themselves with underwater mortgages. And this means that they must stay in the home or they have to sell and lose money. And this is going to lower transaction volume. This is going to lower the turnover rate. And this is why we must understand the meaning of negative equity. Now, for beginners who don't understand what negative equity means that you owe more money on your home than your home is worth. And this is because of falling home values or because of missed payments, aka mortgage delinquency. Now let's take a look at a map of negative equity home values in the US. And we can see that in the coastal states, like Massachusetts, where I'm in, and California and Seattle, where all the high-tech jobs are, the number of homes that have negative equity is relatively low. It's relatively manageable. But if we look at the Midwest region of the US, if we look at the South, we see a lot of states where at least 2.5% of homes on the market have negative equity home values. And the Fed, in their mission to fight inflation, they have not yet stopped their campaign to raise rates. So the percentage of negative equity home values in the US could continue to rise. Now, there is an ACE card for US homeowners at this moment, and that ACE card is tappable equity. Like I said, for beginners, I want to define everything so that we're all on the same page so that you all understand what this means in case it's new terminology. Tappable equity is the amount of home equity available for homeowners to withdraw via a cash out refinance or a second mortgage. And it's typically calculated as total home equity minus 20% of home value. The 20% figure is used as a collateral cushion to protect the lender. And right now, tappable equity has been very strong because of the housing boom cycle. So this is the ACE card that supports the home values that we've been seeing, demonstrating strong resiliency in the US. But that's going to change, and I'm going to show you that right now. Here's why. Too much confidence in the housing market is likely a mistake. We're going to talk about demographics. Then we're going to talk about interest rates. And we can see here that the way we as consumers understand home values is through the Case-Shiller Home Price Index. And it measures the value of single-family housing within the United States. And according to the Case-Shiller Home Price Index, there's absolutely nothing wrong with the housing market. In fact, it looks like it's stronger than ever. But my analyst team and I, we dug into the home price index methodology. We looked at what drives this index going forward. And what we found is that out of the United States regions, several major key areas, Los Angeles, New York, Washington, D.C., and San Francisco, these key areas, they make up 50% of the index. So this index actually masks the weakness being seen in the Midwest, in the South. This index masks a lot of the weakness underneath the hood because it's capturing the areas that have the highest home values. Now, the areas with the highest home values are also the hot spots for tech. And you don't need me to tell you that tech is a major part for employment in the US, accounting for up to 8% of all jobs. And what's happening in tech right now is the number of open jobs is rapidly shrinking. Remember, one of the key things that holds up US housing is employment, is high paying occupations. And the number of jobs in tech, which is 8% of the US workforce, is shrinking rapidly. And the number of layoffs is rising rapidly. So if you're thinking about investing in real estate, if you're thinking about the stock market, we need to be more judicious and selective than ever. Now is not the time to be complacent. In all of our investing, we need to do as much due diligence and research as possible. And I want to take a moment to talk about our sponsor today, Moomoo, and what they offer on their platform that can help with due diligence and research. They offer fund tracking on their platform. This is something that I don't see a lot of brokerages offering. You can understand the mega, large, medium, or small orders happening to certain individual companies on a day-to-day basis. You can also understand institutional tracking. And this is valuable because this allows you to understand which institutional companies are positioned in the names that you hold. Are they hedge funds that have a short-term bias? Are they institutional mutual funds that have a longer-term bias? This is going to help you understand the nature of the companies that you hold and what type of big money is behind it. Additionally, there's also analysis related to shareholdings. This can allow you to understand who are some major shareholders in the names that you own. Are they insiders? Are they family offices? Are they other types of institutional organizations? You want to understand this. You can also understand sentiment via analyst ratings. And I know this data is easy to find, the analyst ratings part, but it's not so easy to find this on a trading brokerage. So that's why being able to have all this information on the Moomoo platform is valuable. And then finally, because of heightened US-China tensions, it's important to consider buying companies like Alibaba or Tencent or Baidu on the Hong Kong listed market so that you reduce any administrative burden if there is a delisting. So now back to the video. We're going to talk about the 20 largest employers in the US. It's on the list here on the slides, from Walmart all the way to CVS and Walgreens and everything in between. And many of these companies have indicated wide-scale layoffs or they've reported weak guidance. And this is important because employment is the foundation of a strong US housing market. And lately, up to 10% of all new home loan applications have been in adjustable rate mortgages. This is a little bit more sensitive to the 30-year mortgage. And if the mortgage rate continues to rise from here, this cohort of homeowners will be under increased stress. Now, a lot of people are opting for adjusted rate mortgages because for now they're cheaper than fixed rate mortgages, but we're starting to see portions of the home buyers take a little bit more risk in order to save money, and this could hurt people down the line. And even if the Fed lowers rates, mortgage rates may not fall immediately. And this is because mortgage rates, they follow the mortgage-backed securities part of the bond market and not always exclusively the 10-year yield immediately. This is an observation that you want to understand. Now let's take a look at consumer health through Google Trends. And the search term being late on rent is increasing significantly over a longer time horizon. And that's because high inflation is eating into people's disposable income. Do not be fooled by a high S&P 500 index. Do not be fooled by the latest FANG earnings. I was listening to the earnings call transcripts, and I heard Tim Cook from Apple say that the company is not seeing any macroeconomic weakness in their business for the iPhone. I don't believe that at all. And I don't think that you should believe that either. If you want to believe it, you can believe it. But I'm going to trust the data that I see. And there's a breakout on search terms like being late on rent, being unable to pay rent. There's also a tick up in search terms like unable to pay mortgage, unable to meet mortgage obligations. So you might ask, isn't the US consumer rock solid? Well, I'm going to show you some primary data. We're going to look at some of the credit card platforms and see what they have to share. Now, nearly 20% of Americans are afraid to check their credit card statements because interest rates are approaching an all-time high. And let me share with you a dashboard of credit cards and their APR history. We can see in this column the average APR has risen from where it was 6 months ago across every category. Cashback, travel, for students, instant approval, rewards, every category. And while consumers are still spending, they're using credit to finance all these purchases. It's being financed on credit. We can see here that the total household debt surpassed 16 trillion in the second quarter. And this applies to mortgage debt, auto loan debt, credit card balances, and the number of credit card delinquencies is starting to rise at the lower tier consumer spectrum for consumers who have lower credit scores below a 700. Capital One and Bread Financial, we can see that the delinquency is starting to rise month over month for consumers who have credit scores under a 700. That's the audience that Capital One and Bread Financial cater to. Now, of course, for the premium segments like American Express, we're not seeing that yet, but I'm going to show you just in a moment some metrics that you should be paying attention to. So you do not need a crash to induce a recession. The affordability issue itself represents a cap on growth. People with below a 700 credit score could have less access to credit when money tightens. I want to give a quick overview on how the credit score works, just in case you're new to this area. Here's the credit score distribution in the United States. We can see that approximately 45 to 47% have very, very good credit score. And that's excellent. If you have a credit score rated as very good or exceptional, that's awesome, that's excellent. But we can see that there's about 1/3 or 33% of Americans that have credit scores that are fair or poor. And this is important because the way these credit scores are composed is that the largest consideration is the payment history. So if people are not paying on time their credit card obligations, that is going to affect their credit score. 35% is the weighting towards payment history. So we can see that 33% of consumers have relatively shaky credit scores, and that's related to their payment history. That's a lot of people in the United States. And we're starting to see this reflected in mortgages. Delinquencies are starting to rebound after hitting record lows. Now let me bring your attention to some primary data. And this is what the Big Four are saying. And no, this is not about PwC, Deloitte, Ernst & Young, or KPMG, not the Big Four accounting firms, the Big Four credit card companies, Visa, MasterCard, Amex, and Discover, because this is the data. This allows us to see how people are actually spending. And back in 2020, here is the market share of the payment networks. You can see that Visa takes up nearly 50%, MasterCard 34%, American Express 7.5%, and Discover 8.3%. And as I'll show you soon, when American Express says that their customers, which are premium audience, high income audience, are not really facing any issues, well, that's only 7.5% of the payment network. And understanding who are the largest card issuers will give you a deeper understanding as to people's spending behavior. Let's take a look at what Amex has to say. They've got that 7% market share like I just showed you. And on their analyst call, they talked about how their customers are continuing to spend. There's no real issues. Once again, Amex caters to a premium customer base, so this isn't necessarily a surprise. But what they did say and what they did admit is that unemployment is the key driver for spending in this cohort. They discussed that, and that's objective, and that's fair. And the Fed is going to drive up the unemployment rate once they raise rates further. Now let's move on to Visa. And this is surprising to me. Visa talked about how there's no evidence that people are holding back despite weak stock market wealth effect. And they're also discussing how the consumer seems unaffected so far. That spending continues to be very strong according to their latest weekly report up until late July. But that's all very easy to explain because it's all debt. It's all financed on credit. And we can see that in the second quarter of 2022, mortgage debt, student loan debt, credit card debt, auto debt, all types of debt is increasing year over year, quarter over quarter, and the number of people that have serious delinquency year over year, every category, mortgage debt, auto loan debt, credit card debt, it's rising. This is something that we need to pay attention to. So the strategy is this. This is the time to spend money only on the essentials. Save up for a rainy day. Invest in yourself. Build your skills. Get promoted at your workplace. Make better decisions. Do whatever you can to keep your job. And your to-do list is this. Get fit, get healthy. You'll need the energy. Tough times are coming ahead. Fire your high maintenance boyfriend or girlfriend. You will need to save money. Find the right mentor or strategist. It can be me or it can be someone else, but do not do it on your own unless you truly know what you're doing. When in doubt, many times your parents know best. Seek their advice if they have found success. Build up a tolerance to take pain. Have the mindset to get ready for challenges. The next few years will represent both opportunity and danger. And once opportunity comes knocking within the next 12 to 18 months, because it will, you must execute on your plan to buy the best companies, stocks, or properties that you can. Do not be seduced by the bear market rally that could extend for the next month or two or quarter, because things, as I've shown you, will make an abrupt turn because there is no Fed pivot. The reset is going to destroy many, but it will not be you. Many things can happen in the next 12 months, and I want you to take full advantage of it. Patience is bitter, but its fruit is sweet. This is the time when we need to be more well-read. This is the time when we need to really be exposed to as much guidance as possible. And remember, it does not matter what stage in life you're in. Large resets are a massive opportunity to recalibrate the landscape. And this is what Pablo Picasso once said: our goals can be reached only through the vehicle of a plan. There is no other route to success. Form your plan, formulate it today. Do not be fooled by the bear market rally. And I will bring the highest level of critical thinking from classical literature and pivotal historical moments into my public letters on investment strategy. And together we will make every month over the next 18 months count. Join my email list. Join me on Twitter. Be my Instagram friend. Stay safe in the markets. Start saving up capital. Get promoted at work. Much love as always, guys. I want you to succeed. Like this video if you enjoyed. Turn on the bell for more. And I just wanted to thank Moomoo again for sponsoring today's video. Make sure to check out the links in my description below, where Moomoo is offering all of my friends here up to 10 free stocks valued at up to $2,500 if you make a qualifying deposit. So check that out, take full advantage of it, and I will see you guys in my next episode.